Understanding and making tax simple for construction and trade-based businesses. Now, I know that a lot of people get confused about tax, don't fully understand how it works, and I also know that a lot of people run into cash flow problems, and I think a lot of it is because of this stuff that I'm going to go through on the board today. Now, if you don't know me, I'm Dean Barton. I've got experience of running companies up to £10 million a year. I'm currently building and buying businesses and scaling them up to £5 million a year, so I know what I'm talking about. So, from a tax perspective, this is how I look at things. If you imagine you've got a business, you've got a limited company, I'm not talking about sole traders, I'm talking about a proper limited company. If you have got money coming into that company by the way of a project, let's make it nice and simple. Let's say this is a £100,000 job. That is the cost of that job to a customer. So you've worked out your price and you are saying to the customer it's £100,000. But on top of that, we've got the VAT. The VAT man wants his piece of the pie. And that just is what it is. You can't do anything about that. So that is 20k. Now, where people get meddled up is that you look at things and go, I've got a £120,000 job. You haven't, you've got a £100,000 job because the VAT is not your money, it's nothing to do with you. There is no profitability on that and you can boast things up and make it feel like you've got a bigger job than what you have. But in a business perspective, you're only talking X VAT in the construction industry. So you say you've got a £100,000 job because you haven't got a £120,000 job because that 20 grand has nothing to do with you. So what I would do, you want to make sure that when this job happens, that 20k, when you get paid this 100 grand, you get paid 120 physically into the bank, but when you get the job paid, you move that 20k into a separate pot for VAT. Because it's not your money, you always want to be ahead of it. And this is where a lot of people run into problems going, oh, I've got a VAT return this month, I've got a VAT bill to pay, because you're not accounting for money properly. Did you get in the habit of doing this? As soon as the money comes in, you move it to a separate bank account that's not the operational bank account where materials and labour is getting paid for and where you're paying the bills from. You actually move that over into a VAT account so it's clear money. Because if you ever get into trouble with a VAT man, you are in a lot of trouble. And you just got to view it and be cold about it, that it's not your money, it's nothing to do with you. You are just collecting it on behalf of the government. And by the way, guys, look, I'm not an accountant, I'm not a financial advisor. I'm just telling you this stuff from the eyes of a business owner and someone that actually, when I first started, I used to look at accounting and tax returns, be quite lazy and laxy-daisy, doing it last minute, trying to save tax, trying to do things to make things easier and better for me because I hadn't accounted for it properly. So I understand that pain, and that's a short mindset. To have the mindset of a real business owner and account for things properly is going to make your life so much easier and a lot less stressful, and you won't run into cash flow problems. Next, when we look at a job, if we say we've got a £100,000 job, you have probably got within that, just for ease of this example, you've probably got 40% of it materials, and you've probably got 40% labour. Now the labour side, the big tax thing that people get wrong in this industry is the CIS, the Construction Industry Scheme, which is where you have to deduct tax from your subcontract labour's invoices on behalf of the government again. So what was happening before is that there's so many tradesmen out there, there's millions of tradesmen in the country, and a lot of them weren't doing their tax returns, they weren't paying much tax because they're just trying to dodge the tax scheme. So what did the government do? They said, okay, we've got a solution. Rather than us chase everyone, we'll make it the onus of the recruiter, the person employing the subcontract labour, that they have to deduct that labour and the tax on that labour, and then pay it to us so that we've got less work to do. So when these invoices come in, if you've got 40k of invoices coming in from subcontract labour, those invoices should say and show that there is minus 20%, which is 8k on this example, that you then have to hold back and then pay to the government later on when you're doing your CIS returns monthly. So that, again, that 8k, you need to move into a pot. you put it into your CIS pot. You can go gross, you can do different things with CIS, but I'm just talking it through in simple, easy to understand terms. That the point is that CIS money, if you get an invoice for 40 grand and 8k of that is the 20% is CIS, move it away. It's got nothing to do with you, and let that pot build up. Because when your accountant comes to do all these returns, let's say you've got 20k in there, but your VAT bill ends up being 15 grand, you're 5k up. You're on the right side of it. You're always going to be on the right side of it if you do it this way. Same as CIS. If you've got other things going on, maybe you've been deducted CIS yourself for a particular reason. I don't know, depending on what your company is and how you're registered, what the setup is. You're always going to be on the right side of it if you put all the money away into a separate pot and you're in a good place. You'd rather have money sitting there as bonus money because you put more into this than less, and you've got to find that money, and that's what you really don't want as a business owner. But that's just basically what it is. And then you're going to be looking at, right, okay, VAT covered, CIS on the labour covered. Then we're talking about the nice stuff, the stuff we want to have when we're in a business, is profitability. And let's just say the remaining 20% of this is profit. Gross profit on the job. So the job has made 20 grand. But what you're likely to have had is you've got overheads on top of that as well. So you've got overheads to come from that gross profit figure of 20k, which means you're probably going to be left with 10% net profit. Let's just say you've got 10 grand of overhead attached to this job to deliver that job, which means there's 10k sitting there, net profit. Now it's this figure that you then get hit with our enemy, corporation tax. And on that figure there, depending on how much company money you're doing, you're going to be paying 19, 25%, but let's just say 20% for ease. You have got 2k here of corporation tax that you're liable for on that 10k. So again, what I always like to do is every month we do a profit and loss review of the company. You actually see what profit did we actually make, what net profit did we actually make. And as example, if we've made 10 grand net profit for the month, I would then want to move over 2 grand at least to the corporation tax pot, because that is a liability that is building and building all the time. And I think where people get caught out with corporation tax is that it's due way after the year is finished. You get 9 months to pay this. So you can get stung if you haven't allocated this money. Whereas VAT you're doing quarterly and CIS you're doing monthly, so you're on top of it most of the time. But corporation tax you can get stung with because it's just 9 months after the financial year is finished. But if you're always putting money away, again, you're going to be on the right side of it. And that's when a good accountant comes in. If you've racked up over the year, and let's say you've got 40 or 50 grand in your corporation tax like pot or a separate account, but your corporation tax bill ends up being 20 or 30 grand, again, you're up, and then you've got money to either reinvest back into the company or draw dividends on, which is actually the next thing, is that you're then going to be left with actual money, 8k, because you've got your corporation tax come off, and there's actually 8k of clean profit after the corporation tax as well, which can be a bit demoralising when you've done a 100 grand job and you think, oh, we're quids in, we're making loads of money here, but you're probably left with around 8k at the bottom. And then if you want to take some of that money out, you then have to pay dividends tax on that as the owner, which depending on what rate you're at, how much money you earn, how much money you take out from whatever it is you do, could be anywhere from 8% up to 40% or whatever it is. It could be a massive effect on this. And what I always like to do, building a company, is that keep at least 50% in the company and have that split that you need to 50% goes back into reinvestment. Depends on what stage of business you're at, what part, if you're in a heavy growth period, you might keep 100% of the profits in the company to be able to buy you more infrastructure, staff and team to be able to do more work and more revenue. But it can be quite demoralising if you are at the highest rate tax and you're losing pretty much half of that money in your dividends rate, that you're actually getting 4k in your pocket. But this is what it is. This is the realities of the game. It is what it is. And you can either fight it, you can try and massage stuff, you can try and move stuff around, but it all comes out in the wash and it all gets caught up in the end anyway. So you've got to be on it with the tax. And if you go with this mindset of just siphoning money off into different pots, you're always going to be in a great place from a company position, and you're never going to be under pressure. You're never going to be in cash flow problems. But it takes a mindset to do this from the off and just be cold-hearted about the money and not looking at the money in one big bank account thinking you've got money, because it's likely you probably haven't. It's operational cash that most of it isn't yours. It's the company's money. That's the way to look at it from tax, guys. I hope that's helped you out. I will do more stuff on this type of stuff if it helps you out. Let me know in the comments below if there's particular videos you want. But in the meantime, I have got a free podcast. If you've not checked it out yet, Construction Entrepreneur Podcast in the link below. Loads of topics on the whole industry, loads of free help. You can listen to it in the van or in the office or on the go at the gym, whatever it is. Check it out and I'll see you in the next video.